We are over a decade into one of the biggest bull runs in market history. Everything feels overpriced right now, especially growth stocks and ETFs. The market's up over 23% in 2024 alone, and it doesn't seem to be slowing down anytime soon. This brings us to the question that every investor has been wondering lately. Is now the time to buy? My answer to that question is always yes, but I want to explain my thought process in more detail in this video. I'm more excited for this video than most of my other ones because this will help you reach financial freedom regardless of your holding preferences. There are a million ways to invest your money, but this overarching portfolio structure is helpful to building and keeping wealth in all situations. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please explode that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. I haven't done this one in a while, but a quick shout out to my Seeking Alpha affiliate link in the description below. If you or a friend are interested in Seeking Alpha Premium, you can try it for absolutely free for 7 days, and then save a bunch of money on your first full year if you like what you see. And now you know what time it is. Let's grow. The thing that works. I recently read a book called Money, Master the Game: 7 Simple Steps to Financial Freedoms by Tony Robbins. Now, Tony Robbins is more of a self-help kind of person, so I didn't learn a lot of investing specific information in this one. But the thing that stood out the most were all the interviews conducted during Tony's research for the book. He interviewed investing legends such as Warren Buffett, Carl Icahn, John Bogle, Ray Dalio, and many others. He asked them all the same set of simple questions, and he found that each and every one of them had a solid system that they never deviate from in any market conditions. Each one of these successful investors used a version of target allocations or value-based investing. And all of them mentioned that sticking to their system in all market conditions is the secret to their success. And that's hard for us humans to do because we get hyped up and we jump up on the bandwagon to keep the good times rolling. In other words, we're buying high. And then we all start panicking when things come crashing down. You know, the news is telling us you better get out now because this is only the tip of the iceberg. It only gets worse from here. We're selling low. The only quote you need to understand and follow, and all the best investors do, was said by none other than Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. And if you're sick of hearing that one from me and other people, then use my version instead. Listen to your emotions and then do the opposite. There is an easy way to put Mr. Buffett's legendary advice on autopilot. Let's dive into that. My simple system. I predict that I am not the next legendary investor. But would you believe me if I told you that this average Joe's core mix of ETFs have done the following since 2012? Outperformed VU by over $200,000, outperformed VT, the world market, by over $500,000, outperformed VU and VT for each of the past 11 years, never missed buying the comparative dip within my mix, and all of this while making 0 decisions, system rules only. Those are all true, and I spill the details in my monthly portfolio updates. You can go check those out if you want to, so I'll keep it short and sweet in this one. I think VU, or any low-cost S&P 500 fund, is the best investment out there to dollar cost average into for all investors that want to keep it crazy simple. There is a reason why over 90% of investors fall short of the S&P 500's returns. It's your gut and your ego. Even knowing all that, I always thought that I could outperform the value and the growth sections of VU with my own picks. Of course, passively managed ETFs for each. I don't want the whole basket of 500 companies within the United States, but I also don't want to get too cute and start hand-picking my own mix either. I'll take the baskets that have the most favorable factors overall. I like VGT for growth and SCHD for value. And look, I don't think I'm some special guru either, so I also add VU, the competition, to the mix as well. And the secret formula for me has been a third each of SCHD, my value, VGT, the growth, and VU, a mix of value and growth. Now, you could have a completely different mix of passively managed ETFs for your different portfolio sections, or you could just roll entirely with VU or VTI or VT as well. There are many viable solutions out there. For example, maybe you're not as much of a tech bull as me. So instead of VGT, which is entirely tech, you go with something that's half tech like QQQM or SCHG for your growth section. You stick with SCHD for value, and then maybe you go VTI for your cornerstone. It doesn't really matter as long as you pick something that represents what you're trying to have that section of the portfolio do. But regardless of your holding mix, there is a right way to manage it. Should I buy right now? This is an easy and difficult question. The answer is always yes. Dollar cost average your money into the market over many decades, regardless of what's going on. Remember, nobody has ever lost money in the market's history over a 20-year stretch of dollar cost averaging into the S&P 500. Not one cherry-picked time. But even knowing this, I find that whole greedy, fearful thing to be a little bit confusing. I have no idea what the market is going to do. I've been telling people yes for years when they ask me things like, should I buy VGT right now, even with how crazy overpriced everything is? And I always feel a little uncomfortable with this because I know it could fall something like 30% in a hurry. So there's always this caveat. The answer is always yes, as long as we agree that we will never panic sell when the market's doing its crazy business. And in the case of like VGT and SCHG and things like that, we have at least another decade ahead of us of being able to dollar cost average money into the market before retirement. I've purchased VGT only to see it crash shortly thereafter many times over the years. But when I zoom way out, my average cost is now $246 per share, and VGT trades at just over $600 as I record this video. This is where target allocations will save you during the bad times. And we'll continue with using my portfolio as an example, but you can apply this to any of your portfolios. When VGT, or growth, is just going to the moon like it has lately, I find myself loading up on SCHD with my purchasing decisions to get it back to its target allocation. And this is where those emotions come into play. The inner voice in your head and the news articles you read, and if you turn the TV on, everyone's screaming, buy more VGT, it's the hot item right now. But adding SCHD is buying the comparative dip within your portfolio. We are systematically buying low. When growth crashes, and it will, we'll find ourselves loading up on the VGTs of the world to get them back up to the target allocation. We're getting more shares per dollar that we throw into the market this way. And this should go without saying, but I'll throw it out there just in case. Your system should be built with quality investing options in the first place, so buying the dip is always a good thing. You don't want to be loading up on some speculative thing that could go to zero, is what I'm trying to say here. And I know sometimes this stuff is easier to see, so let's hop over my screen and look at a quick example of buying to our target allocations in a realistic scenario of someone investing and building wealth during their career. For this example, we have a $100,000 portfolio. Now, this is an example of portfolio target allocations that I would have. I'm in my 40s, so yours might look completely different. If you're really young, you might have your growth ETFs being over 50%. But don't worry about the holdings. What really matters is the percentage of each holding. So for example, I want 20% of my portfolio, so with 100,000, that'd be $20,000, is VGT. And my target allocation for QQQM is 10%, so that would be 10,000 of the $100,000 portfolio. And you can see down the line, 30 for VU, 30 for SCHD, and 10% for cash equivalents, which for me is a money market or a high yield savings account, a combination of those two, with like it at 10%. So things are really easy when you first start, or if you've been building this thing and they're perfect, just like this. It's like, all right, well, we're right on our allocations. But as things happen, let's say we go on a bit of a tech run, like in the next month before you put in new money, VGT and QQQM have gone up by 5%. VU's gone up by 3. HD saw a little bit of a downturn at -1. And cash, of course, is usually going to stay flat. You can see here that your portfolio is now worth $102,100. So we have $2,100 of unrealized gains so far, and VGT is overweight by 0.6%, QQQM overweight by 0.3, and same with VU. So when you put in your next, say, $1,000 for that month, or $500, whatever you put in on a monthly basis, and again, make it as much as possible, you'll be happy. You'll want to put it towards cash, so your money market or your high yield savings account, or SCHD. They're both underweight. You can see SCHD is 0.9% underweight, and your cash is 0.2% underweight. The way I've historically done it is I usually do cash first. So if I'm cash poor, that means everything on a whole has collectively gone up. I'd replenish my money market. And then after my cash is at 10%, then I look to see which is underweight. So in this case, I'd buy SCHD. But let's check out a tech crash. You know, something like this could very realistically happen. It has in the past and it will again. Let's say now our portfolio is looking like this. So our $100,000 portfolio saw these changes with the holdings and it's now worth $95,900. See, what happens here is when you put in your $500 or $1,000 a month, you'll have that and extra cash. So you'll have $10,000 of cash still, and then you'll have, let's just call it $11,000 when you put in your contribution this month. And so cash will be overweight. And what you want to do is you want to get it back down to 10%. So you need to buy the comparative dip to get your cash back down to 10% ultimately. You'll want it at $9,590 here. That's 10% of your total. So when you take your contribution and what you're already over here, you'll trickle that back into VGT needs some love to get back up to 20%. QQQM needs to get back up to 10. And VOO is light up to 29.4. It really is this simple. You don't even have to have a fancy spreadsheet. Really all you need is this that shows you what percent you currently are of each thing. And then once you know that, you just buy the one that's underweight. And one last thing on the systems, just going back to a couple of the legendary investors, and you could say this about all of them, but I'll take two different scenarios here. Warren Buffett. You probably know that he does not strictly adhere to something like a target allocation system that I'm always talking about, or like that Jack Bogle talked about all the time. Warren Buffett is more of a value-based investor, but he sticks to his system, and that's the point. So when there's no attractive investments out there, he won't buy. He'll hoard cash, and everyone's gonna be making fun of him. He's missing out, you know, Buffett's out of touch, and he's doing it again. But then the market mysteriously seems to crash, and then he deploys his money into good value-based investments. So he sticks to his system even when everyone's calling him out and saying he doesn't know what he's doing anymore. And now let's talk a little about Ray Dalio. He also, well, he does a lot of different things, but one of his recommended portfolios is the all-weather portfolio, and it has different asset classes involved. And so recently on this bull run, he looks really bad, right? It's like, oh, this guy doesn't know what he's doing, but he always recommends to stay the course because let's just say he's like, you know, you guys are right. I'm gonna sell out of all these like gold and that kind of stuff, bonds real cheap, and get into all these like VGTs and QQQs. And then all of a sudden the market crashes. He's lost twice. When you deviate from your system, your well thought out system, then you're missing the point. It's there to protect you as the times change and these natural rotations happen. So in Dalio's case, he'll stay the course and eventually things will correct and then his all-weather portfolio will look a lot better on paper. Anytime we try to interject with like what the news is doing or what you're reading about, almost every time you ultimately sell low or buy high compared to the next thing that's gonna happen. You're going to find yourself running into trouble. Pick something, build it, stick to it. Conclusion, let's summarize our buying strategy because building wealth really is this simple. Build a holding mix that works for your timeline, your risk tolerance, and your goals. And again, if you don't want to customize anything, going with 100% VOO is going to do fantastic in all markets long term. Dollar cost average as much money as you possibly can into your given system. Make it a bill. Pay yourself first. And when you put these new dollars into the market each week or each month, whatever your cadence is, be sure that you buy the position that's the most beat up, the furthest down from its target allocation. So you buy back to the target, AKA you'll always be buying the relative dip within your mix, within your portfolio. You know, say you go 60% stocks and 40% bonds, it's the same concept. If stocks go on a crazy run, when you rebalance, you'll put more back into bonds. It's kind of like that logic, but it's only real time moving forward. Instead of selling, you're just buying to your target allocations all the time. Now you know how to handle it if you're sort of the investing guy within your group of friends and people ask you, should they be buying right now? Remember, the answer is always yes. And then part 2, because you're one of the real ones, is to point them to this video. Check out one of these 2 videos to continue down your path towards financial freedom. It's time to build a world where your company does not own you. Thanks for watching, and I will see you here in the next one. Peace.